The 10-year period from '08 to 2018 were the best 10 years that Hong Kong will ever see. Will never happen again. The Hong Kong banking system is now almost 9 times their GDP.
Wow.
Of the, call it today, it's 850% of GDP. 280% of GDP of the 850 is lent to Chinese property developers into China. They're the most levered nation in the world, with the most expensive real estate in the world, with an economic arrangement with a country that is no longer synchronized. It is a recipe for disaster.
If you remember, a month ago, Kyle Bass was on Real Vision talking about China, and he said he had one big trade for us, the really big one, the one that he'd been doing all of his work on. And he refused to unveil it until he told his investors and got himself kind of set up and positioned. That moment's now. Kyle's back to come and tell us the next big trade, the trade that he thinks is one of the greatest opportunities in financial markets. It's going to be super interesting for us all to sit back and watch Kyle Bass unveil this great idea. So Kyle, you've come with a tie. I've got my collars up. What you promised me a month ago is you're going to come with the killer trade. The big idea that you've been working on for a while ago, and we kind of alluded it on Real Vision to people, and now you're back and you're ready to kind of unveil what is, you and I have spoken about it a little bit, and it's, for me, fascinating and almost incredible.
I appreciate
Talk me
that.
through it.
Let's start at the beginning. So, for the last really 3 years, we've focused on, as you know, I know there's 6 or 7 years, we focused on China's financial system.
Yeah.
And that's taken us to understanding the flows and the plumbing of capital and how it flows in and out of China, whether you're looking at Hong Kong or China, or you're looking at the listed market or the domestic market in China. The majority of the capital flows through Hong Kong. And when you look at Hong Kong as a sovereign, I'll tell a little bit of a story as far as the existence of Hong Kong in its economic and financial state that it's in today. You have to look back 36 years. You really have to look back much further than that when, the UK or Great Britain really fought a couple of wars, the First and Second Opium Wars, and then the balance for the new territories, and, took over Hong Kong Island, Kowloon, and the new territories. And they basically ruled those territories for a very long time. And at some point in time, in the late 1970s, early 1980s, Deng Xiaoping started, I think, some rhetoric back behind the scenes, some conversations with Margaret Thatcher on handing Hong Kong over back to the Chinese. As you know, the British basically secured their rule over Hong Kong with a 99-year lease.
Yeah.
The Chinese wanted that lease to end 1997. And threatened, I think, the British in one way or another to get them to do it a little sooner. And so while these negotiations were going on, word got out that the Chinese were talking to the British about a handover. And if you noticed what happened then, the Hong Kong currency had about a 50% decline versus both the dollar and the pound going into 1983.
Yeah.
And then in late 1983.
So it was a free-floating currency then?
It was a free-floating currency then, yeah. So, but a 50% deval over just a handful of years, to the extent that the South China Morning Post was saying it's becoming a banana republic, the currency's in a, quote, free fall, and then they pegged it to the dollar, the US dollar. Fascinating, right? It's being controlled by the British, and yet they pegged it to the US dollar, looking for more stability than I guess the British had.
Nice dig.
And now we face Brexit. God only knows what's going to happen next. But I think that back then they engaged in a peg to try to bring some sort of stability, to calm the nerves and the psyches of investors in Southeast Asia, and primarily Hong Kong. Because, as you know, investors were thinking with Great Britain, there's a legislative democracy, there's basically a financial stability, there's rule of law. There are all the things that capital needs to invest and make real investments in the sovereign or the territory. And with the idea that China might take back over sooner rather than later, the money left, and that's why they had to institute the peg. So the UK Chinese agreement, the Sino-British agreement in 1984, stipulated or set forth the rules by which Great Britain would engage with Hong Kong in the future, and the handoff would be, July 1st, 1997. Fast forward from 84 to 92, when the U.S. entered its Hong Kong U.S. Policy Act. Both Great Britain and the U.S. treat Hong Kong as its own sovereign, as long as it maintains autonomy in its economic affairs, in its legislative affairs, and in its rule of law.
What does autonomy mean?
That no one else is running the show. Right? This
okay.
agreement stipulates that it is a special administrative region of China, but it will be treated as Hong Kong as long as those things are maintained. Like, I'd love to cover that secondarily.
Yes, we'll come on to that
in our conversation. But
hence my question: what's autonomy? But
yeah, that's the word's very important.
Yeah.
So when you look at today, if you just look at Hong Kong from a macro perspective, it's really important to think about what happens when you peg your currency to another. Right? There's the pegged currency, then there's the anchor currency. The anchor currency in this case is the dollar. What you're doing is you're basically saying, I will adopt their monetary policy, I'll adopt their yield curve, right? I will basically let Jesus take the wheel and let the US run my economy. Now that works actually fairly well as long as there's a synchronicity in economic outputs, right? I.e., if the economies are working together, if one grows, the other grows. If one goes into decline, the other goes into decline. That kind of relationship actually works. If one economy is growing while the other one's declining, and you have to import monetary policy in, i.e., the same rates curve, it's a disaster for the one that's declining. And so 36 years ago, the US was the engine for the world.
Yeah.
And as the US economy went, the world economy went.
Yeah.
There was synchronicity. And if you fast forward to China's ascension to the WTO in 2001, China's move into becoming the second largest economy in the world with roughly 15% of GDP, and you look at the infrastructure build that China engaged in since 2001 in their southern ports, really southern and up the coast, what you see is Hong Kong used to be the biggest port in the world. They were a dollar-based goods exporter and re-exporter of goods for southern China. They were essentially China's southern port.
Yeah.
And they were very functionally relevant to China especially in the early 1990s. They represented a quarter of China's GDP, actually almost 30% of China's GDP. Today it's 2.5%. So they were relatively unimportant, very important, and now unimportant again from an economic perspective, right? From a capital raising perspective, very important to China. But from an economic output perspective, not that important. I think if you look at how Hong Kong's economy has changed over the last 36 years, they've gone from a goods exporter and services importer, and right in the financial crisis, that flipped. And we have a chart in here whereby you see the blue bars are goods, the red bars are services.
Total flip.
So it looks like the financial crisis flipped them, but that's just coincidental, actually. It was the southern port build-out that basically moved China's, let's say, ownership of the top 10 ports in the world from 9% in 2001 to 60% in 2015. So that's what happened in forcing Hong Kong to actually reinvent its economy. Hong Kong today is a massive net goods importer. It's hard to believe that.
Yeah.
And they're a services exporter, and they face China, right? For travel, for financial services, real estate services, legal services. Call it 80% plus of their economy relies on China on the export side of services, and they import dollar-based goods.
Right.
And so there's no there's no synchronicity between the two economies.
So they've decoupled essentially from the US economy.
Yeah. And so if you and I were running Hong Kong today and we said, how should we run our economy? We would say pegging to the dollar would not be the right idea.
Peg to the RMB, I guess, if you can do it.
Yeah. And so their economic arrangement with the US is one that has changed dramatically over 36 years, but on the face of the world, it actually hasn't changed at all yet. And then you look at the macro of Hong Kong. If you import US monetary policy, as they went into 2008, right? In 2008, US took rates to zero.
Yeah.
So historically, the anchor currency is the one that, let's say, is the fiscally responsible one.
Yeah.
It's the one that keeps inflation under control. It's the one that keeps rates where they should be. It keeps a more stable economy, and that's why people anchor to them. In this case, the inmate's now running the asylum. We just took rates to zero. Imagine this. 2008, US takes rates to zero, so Hong Kong rates go to zero. And their largest trading partner, China, goes to the gas pedal. So the 10-year period from '08 to 2018 were the best 10 years that Hong Kong will ever see. Will never happen again. So no wonder real estate went up 500 to 700% in a 10-year period, right? No wonder the price of Hong Kong real estate is $10,000 a square foot.
And that's why that chart of services, because it all becomes finance. Because
It all
it just goes to money, right?
Well, it's free money.
That's right.
And your largest trading partner is growing double digits.
Yeah.
And so what happened? The Chinese came in with all their money they were making and bought all the real estate in Hong Kong.
Yeah.
So now it's completely unaffordable. I think, the most expensive real estate in the world. And what's interesting is the Hong Kong banking system did exactly what Iceland, Ireland, and Cyprus did. The Hong Kong banking system is now almost 9 times their GDP.
Wow.
What was the common denominator of the countries that fell apart in the European crisis? They fell like dominoes. It was the size of their banking system when they hit a slight recession.
Yeah.
Broke the country, right? Because the country has to go in and save the banks, save depositors. And that means the sovereign has to lend into the banks, and it breaks the sovereign because the banks are hyper levered to the GDP.
But what have they lent against in Hong Kong? Because this has got to be the key, right?
So this
the
is
US
fun-
is the housing market.
This is the fun one. So of the, call it today, it's 850% of GDP. 280% of GDP of the 850 is lent to Chinese property developers into China.
Wow.
The rest is lent to domestic SMEs and mortgages. So I hear a lot from the various sell-side firms that we call. They say, oh, well, Hong Kong mortgages, they're only 50% loan to value, not a problem. I said, really? How do they afford a 50% deposit on the most expensive real estate in the world? They said, oh, that's easy. So the bank lends 50. The property developers lend 35 in a second lien. And families, the families or friends lend them the other 15. I said, so how does that work? And they said, well, that's easy because housing goes up like 10 to 15% a year. So in the first year, this is a partner at one of the biggest firms in the world tells me this, that runs the real estate business. In the first year, they refi their family out. And in the next 2 years, they refi the developers out, and then they have a 50% LTV loan. I said, but what if prices go down? So, prices don't go down. Literally, I'm hearing this again.
We've heard this before.
Right? And so there's this belief that the loans in the banking system are safe because of their loan to value ratios. I think we all know that that's not going to be true.
So of the Hong Kong money, the banking system, is most of that debt?
Oh, yeah.
Debt in China.
Oh,
It's
yes.
Chinese debt.
Yes.
There's nothing to do with the Hong Kong domestics or...
Oh, no. So 280, so of the 850, 280 is lent to China. The balance is lent to Hong Kong domestics.
Right. What the hell do they do with it all? Because there's
So
not that many people in Hong Kong.
Private sector financial credit is the highest of any developed nation in the world. 300% of GDP. Look at the US and Japan and look at where Hong Kong is.
Wow.
So you have the most levered banking system
some
in the
weird
world.
mechanism that is flowing back into China? Just feels that you don't look at the streets of Hong Kong and think everyone's completely borrowed as much money out of the eyeballs. It feels like there's another mechanism.
Well, they could have
at
taken
play.
the money and invested it in China, right? I mean, all I'm saying is domestic private sector credit to GDP is 300%. Banking assets to GDP are 850. So they're the most levered nation in the world, with the most expensive real estate in the world, with an economic arrangement with a country that is no longer synchronized.
Right.
It is a recipe for disaster.
So everyone's going to have in their head, yeah, I heard this all before in 98. And every hedge fund who tried to take advantage of that peg breaking didn't break. What's going on now that's different? Because you've looked at reserves and a whole number of different things.
Yeah, let's talk about 98 first. I think it's important to see the HKMA had a decision to make, right? Either revalue the peg or suffer a massive debt deflation.
Yeah.
And now their debt was nowhere near what it is today. But what they did, if you look at this chart here, from July 2nd, 1997, which is when the Thai baht broke the peg, interestingly enough, one day after the handoff from the Brits to the Chinese, July 1st, 97 was the day of the handoff. July 2nd was when the Thai baht broke. It's not coincidental. So from July 2nd of 97 to the beginning of 2003, Hong Kong real estate dropped 70% in value.
Wow.
Right? So they elected to take a multi-year, enormous, basically deflation-led depression.
Yeah.
So the way that they made that election during the crisis of 97, 98 is they spiked overnight rates up to 20%.
That's right.
So US rates were 4.5%, 5%, right? So they took rates from 5 to 20 on a spike to thwart any currency from leaving. They were trying to keep currency there, right? Well, today, the fascinating thing about their banking system, their mortgages, their assets, their loans in their system, the substantial majority of all of those loans indexes to 1 month HIBOR, their overnight lending rate, and they all reset every month.
Right.
So imagine taking an economy at max leverage and raising rates to keep currency from leaving.
Possible.
That arrow is out of the quiver. They can't do it this time. So if you look at the IMF's Article 4 review of Hong Kong, the number one risk is the fact that all the loans are floating and indexed to 1 month HIBOR.
It's the same with the UK back in sterling crisis, because all UK properties borrowed at the short-term rate.
Right. Same with Hong Kong. Now, they have a mechanism in their mortgage market that has a cap at prime minus a rate, call it 250.
Yeah.
Prime's like 5.
Yeah.
And so the Hong Kongers believe that even though their rates have gone from an effective 1.25% or 1.5% to 2.5%, that there's a cap. So the most fascinating thing was in September of 2018, I think it was September 29th, was the day the Fed raised rates. That night, Hong Kong raised the prime lending rate by 12.5 basis points. That's it. The next week, the South China Morning Post ran stories every day talking about real estate dropping 6 to 10% in a week. Because all of a sudden, the Hong Kongers figured out that the cap could move. Right? You can't just move base lending rate, you have to move prime.
Yeah.
If rates are going to move up.
Yeah.
So 12.5 bit move on the prime lending rate scared the entirety of the Hong Kong real estate market.
Wow.
That's why you see that hook down there at the end of this chart.
Yeah.
That started the end of September.
So then the other preconception is right now, same as it was back then, is Hong Kong has unlimited balance sheet, the HKMA. You know, because even I'm burnt by the HKMA because, you know, they even bought the equity market.
They did.
They did. I mean, they killed everybody, every hedge fund. You can talk to Paul Tudor Jones, Lewis Bacon, the whole lot of them. I'm like, no. I don't want to fight these guys. So talk to me about the HKMA, about the options they've got in this situation.
Well, let's talk about Norman Chan, right? The head of the HKMA. He's going to retire here in the next 4 or 5 months.
Right.
So they're gonna look for new leadership. As far as the HKMA and this idea that is, let's say, talked about by the sell side a lot with regard to they have a pile of dollar-based reserves. They have what they call a perfect currency board. For every 7.8 Hong Kong dollars in the system, there's a dollar in the system.
Yeah.
And they've got more than their entire GDP in money in circulation. Everything's going to be fine. When you think about that, if currency boards worked, then Argentina, which used to be 1-to-1 to the US dollar in 2001, just think about this, 2001, 17 years ago, 18 years ago now, it was 1-to-1. You know what it is? We know what it is today, 43-to-1, maybe 44, who knows what it is today.
Exactly.
Right? When you look at a currency board or you look at a currency peg, let's say that identity is true. For every 7.8 Hong Kong dollars in the system, there's 1 US dollar in the system. You can't take it below that and run a fractional reserve peg. I guess you can, but you'd lose, confidence would be lost very quickly.
Yeah.
And so the way we look at it as currency in circulation, which you can't really, let's just say, go into. You can't go into that cookie jar. You have to stay out with your excess reserves. So Hong Kong reports every night what their excess reserves are. They call it their aggregate balance.
Right.
And just 2 years ago, that was about 170 billion Hong Kong dollars. It was real money.
Yeah.
In the last year, they've spent 80% of that money defending the peg. 80.
Wow.
They have 50 billion Hong Kong dollars left. Call it 6 billion US dollars left before all of a sudden they're going to have to make a decision. Now, can they go find some other money in their economy somewhere, somehow, to keep defending the peg? This actually goes back to this concept of even sovereign default. And if you and I are running a sovereign or you and I are running a peg, it's actually similar. Do we think that it's anomalous, that this attack is speculators, or is it the macroeconomy telling us that maybe the peg's not pegged to the right thing?
Yeah.
And maybe not the value is the right value.
Yeah.
Right? Is it temporary or is it a secular problem?
See, in '98, what was different is everybody was under pressure.
Yes.
It wasn't Hong Kong's
problem. Exactly right.
But nobody's under
And it wasn't
pressure.
Hong Kong's leverage either. And it wasn't Hong Kong's housing market.
No.
Or banks.
No.
It was people running into dollars, afraid of China taking over the region. And so now you have this hyper-leveraged system in the most expensive real estate market in the world. You have the natural moves. So right now, if the Hong Kong dollar and US dollar are interchangeable, freely interchangeable, which they are at the peg, you can earn 83 basis points more on an overnight rate if you just have a dollar deposit. So if I ask you, Raul, would you rather have 1% or 2% on your deposits?
Yeah.
And it's freely interchangeable.
That's right.
You don't have to be a genius to figure that one out.
So
that's why the pressure continues to mount and mount and mount. People are just converting to dollars.
So I don't think many people will be aware of what's actually going on in the Hong Kong currency. Explain a bit about the situation of what's been going on and how it's been trading versus the peg.
So it has a very narrow band. So the peg was set in 83. They adjusted it to a band. The band is 7.75 to 7.85 to the dollar.
Yeah.
It's basically a little more than a 1% band.
Yeah.
And so for the last few years, it's traded at the strong side of the band. And in the last 1 year, it's traded to the weak side, to 7.85 to the dollar. And so what happens when
a flat line there, though?
But what happens is if you're going to maintain a hard edge like they have to maintain, they have to sell dollars and buy their own currency. So they have to sell their rainy day fund, their excess dollars. They have to sell. So they've sold 80% of those dollars in a year's time. Just think about that. So what happens when they sell the last 20%? So two things happen. Either they find more dollars by mortgaging or leveraging another asset, or requisitioning funds from somewhere. It's not the only money they have.
Sure.
And we've done a very in-depth analysis, not in our letter. We can cover that another day. But let's just say they have a decision to make. They can raise rates up to the level where they stop the currency from running, i.e. converting to dollars, or they can find some more money to fight the peg with.
Now, the other question is this is clearly tied into the Chinese story. Is this also capital flight from China via Hong Kong? Because that's always been my premise, that this is a mechanism that's part of a bigger story and too difficult for the HKMA to stand in the way of.
I'll say that your premise has been right for a few years, in the last few years. But if you remember when China closed the door, really shut down and put their fingers in the holes of the dam of the money running out of China, they did that really at the beginning of 2017. I'll give you some anecdotes. I have friends that are some of the biggest art dealers in the world, and they do these Art Basel shows, right? And there's an Art Basel in Miami, there's an Art Basel in Hong Kong. And so in the last couple of years, this year in particular, my friend that sells all the fancy paintings, not one Chinese buyer this year, not one. And 3 years ago, they were selling them like hotcakes to the Chinese. So they can't get their money out. And they're policing that very, very,
But my guess is a lot of them
rigidly.
put the money, as you said earlier, into Hong Kong, right? So their first step was put it into Hong Kong real estate, right? You're outside of China, but you're still within China. Then you're free, you liquidate the property or whatever you do.
And in theory, there's a rule of law in Hong Kong, right?
Yeah.
It's still a UK rule of law.
Yeah.
In theory.
In theory, exactly, which we'll come a little bit onto in a sec.
Yeah.
But I just have a feeling that money is flowing out. So let's say they sell real estate, it's mainland money that's been there for 10 years.
Yeah.
It now finds its way out because they're looking for more security. So it goes to Vancouver, it goes to Sydney or wherever.
Imagine if you're a Hong Kong family that has been there for generations, and let's say you've built wealth over time. You would have to be foolish. In a freely convertible market, you'd have to be foolish to leave it in Hong Kong dollars, given the macroeconomic instability of Hong Kong. And what happens in a peg where 36 years there's no volatility, right? No volatility begets no volatility until it doesn't.
Absolutely.
But if you look at the macro, if you had your entire wealth invested in Hong Kong dollars and Hong Kong stocks and bonds, and I sat and talked with you and explained to you how bad the macro is, and then you say, well, it's probably going to be a political situation. So I don't care. I'd rather own US dollars tomorrow and not be on the hook or at risk of my home currency collapsing.
So let's talk a little bit about risk in terms of the risk to the people in Hong Kong. Because we talked about autonomy and we both kind of sniggered about autonomy in Hong Kong because it feels like, and from friends of mine in Hong Kong as well, and you've got friends in Hong Kong, that autonomy is going fast.
So last night I had dinner with a friend that just sold both pieces of real estate that he had there, and he moved his family to London.
Oh, really?
Gone. He grew up in Hong Kong, generational Hong Kong family. The moment that China started actually floating a proposal to be able to extrajudicially grab someone off the streets of Hong Kong and take them to China without any court proceeding, that's scaring the Hong Kong, not only the Hong Kong elite, but the 85,000 Americans that live there.
Yeah.
Right? In the past, we all know that the MSS from China grabbed booksellers that were writing books about President Xi that he didn't like, and they came in the middle of the night, took him and ripped them back to China. That was kind of a political grabbing, and everyone was up in arms about it, and there were 4 booksellers that went missing for a while, and then they resurfaced at some point in the future, never to sell another one of those books again. This is a different thing.
Yeah.
The proposal in the manner in which it's stated today, and Carrie Lam's government is the one making this proposal. So, she's not really democratically elected, right? She's chosen by President Xi to be the CEO of Hong Kong, and she's proposing this. And her proposal it states that there'll be a judicial review, i.e., if the crime that is supposedly been committed by the fugitive in quotes, is a crime also in Hong Kong. So let's choose murder, right? It's a crime in both places.
Yeah.
If China calls the police station in Hong Kong and says, Raul committed a murder in China, arrest him and send him over here, the court says, their judicial review is, okay, is murder a crime here? Oh yes, it's a crime here, we've got it. The presumption is guilt. So there is no court process to determine whether or not this is a political movement or not, or whether or not you actually committed a murder.
So how can people like Li Ka-shing remain within Hong Kong?
I think they have to leave. I think it's a real problem. I mean, my friends that are very well off are leaving. Now, if you remember, Nancy Pelosi just had a group of 10 delegates from Hong Kong here to the States 2 weeks ago and was very forceful with some language and said, there are 85,000 Americans that live in Hong Kong, and we are very concerned about the new proposals that are being floated in the legislature in Hong Kong. If this becomes law, more importantly, it goes back to this word autonomy. The Brits agreement with Hong Kong and the US agreement with Hong Kong, for instance, the 1992 US Hong Kong Policy Act is re-ratified annually. So the State Department submits a report to the president, and then it's up to the president to either take the State Department's recommendations or do whatever he wants to do. If he determines that they are no longer sufficiently autonomous, we can treat Hong Kong as China. Well, that changes the entire complexion of Hong Kong's economy. Meaning, all of a sudden, all the tariffs, all the restrictions, all the rules of trade that we engage with China on, we start treating Hong Kong that way. Today, Hong Kong is treated as its own sovereign. There are no tariffs, it's free trade, unabated free trade. And as long as, again, they maintain that autonomy, we honor that agreement. If this law goes through, it is a clear violation of our Policy Act, and it's a clear violation of the Brits' agreement with Hong Kong. That in itself will force. You remember in 1995 during the tequila crisis? What happened? What precipitated the Mexican decline? What precipitated Thailand in '97? It's always one thing. It's always the wealthy lose faith or fear the government, and they start moving their assets out.
Yeah, Argentina was the same.
That's what happens.
Yeah.
So if the wealthy in Hong Kong either convert to dollars or start leaving, which I think both will happen, then Hong Kong's finished.
So what do you think? How does this play out? So we've seen the HKMAs running low on the excess reserves.
Yep.
The currency is stapled to the limit, so they're having to intervene almost every day.
Correct.
The US dollar, as of today, looks like it's breaking higher and is going to get stronger, which will only put more pressure on this situation. How does it play out? What's going to happen in this?
I mean, I really don't know. All I know is the pressure that is being applied is not this is not anomalous. It's not a one-off. It's not they're just caught up in the tide of people moving to dollars everywhere, and Hong Kong has none of its own problems. You're talking about the most levered developed economy in the world, with the most levered consumers in the world, with the most expensive real estate in the world, all of a sudden having a real problem.
So why do people look at Australia and Canada before they look at Hong Kong?
Again, 36 years of stability begets more stability. It's an availability heuristic, right? It's the way we think.
Because we all think, look, Australian housing market's going to blow up, the banking system's going to get into trouble.
Yep.
Canada, probably the same. But there's nobody talking this Hong Kong story. Everyone just says, well, that's stupid because Hong Kong will be fine.
Yeah, well, if I were living in Hong Kong with my wealth there, I would have already converted it and left.
And the currency is telling us something. Every day there is money leaving that country and nobody's noticing.
And you know what's interesting? The architect of the peg himself, Greenwood, wrote an article just last week, published in the Wall Street Journal, I believe. In it, he says, people are starting to speculate on the Hong Kong dollar. They've lost money for 36 years. They'll lose money again. It's a perfect peg, nothing to see here. Then why did you write the article?
Yeah, you can't say these things.
It's just like when Juncker, going into the European crisis, he said, Greece will not default. It'll never default.
Yeah.
And then we didn't have a meeting. And then a few finance ministers said, well, the reporter said, we just talked to other finance ministers that were in the meeting. And they said, so you just lied to us. He said, listen, when it gets serious, you have to lie. You remember that?
Yeah.
So look, no one's ever going to tell you this is coming.
Are the forwards trading through?
No.
That's interesting.
They're still trading on rate differentials.
Right.
So I think when they run out, then you get the next move.
I don't think people understand quite the impact that if Hong Kong were to devalue or have to abandon their peg, let's say they dressed it up as we want to repeg to the mainland.
Yeah, that makes a lot of sense.
It would make, politically you can kind of get away with it. But what that does is immediately put pressure probably on the Chinese currency itself, but across the region because, Hong Kong was one of the stabilizing economies. It's Hong Kong, Singapore, they're the two free trade zones. You do that, it's going to start devaluing all of the currencies across the region.
I don't know. I mean, I hear you.
I do.
But I don't have an opinion on it, truthfully.
No.
I don't. I think that...
My view is the knock-on effects are enormous.
They typically are. And subprime wasn't contained, right? No matter how big the problem is, there's never true firewalls around it.
But your focus is on, okay, this is the one thing.
Yeah, I mean, I think that the rate differential is really interesting, and I think that as a global investor and as someone that looks at risk the way you look at risk, there are a few people that this should appeal to. Number one, it should appeal to anyone that has their wealth in Hong Kong dollars. They better pay a lot of attention here because right now it's free to hedge yourself.
Yeah.
It actually pays you to switch to the other currency.
Yeah.
That doesn't have all the problems that are endemic in yours. The second group of people are the global asset allocators. Yeah. Right? If you and I are running a pension endowment or sovereign wealth fund, and we have money, to your point, allocated not only to Hong Kong, China, Southeast Asia, this will be a destabilizing event. And so maybe there's a way you could hedge yourself against that. There is one, right? And the most interesting thing about that is The hedge pays you. You don't have to pay for the hedge.
And so, HSBC.
Yeah.
So HSBC is an enormous bank, split between London and Hong Kong. So surely they are doing the hedge, right? I mean, if you're the CEO of HSBC, you're just going to be switching all of your, and actually, bizarrely enough, I do know one of the treasurers or the treasurer of HSBC. I could probably find out, but somebody they would know, and they would have some idea with what they're doing with their reserves.
The funny thing is about Hong Kong also, just think about it. The two largest banks in Hong Kong are two orphaned children of British financial institutions that are bankruptcy remote. They're firewalled from a corporate capital structure perspective.
Well, between the UK and Hong Kong.
And they don't have any British depositors. So, I'd be worried if I own we don't have any positions in any banks, to be clear. But I can promise you I wouldn't own either one of their equities.
So there's another trade. So back in my youth, I used to do a lot of these equities pair trades.
Long the parent, short the
Well, particularly because there was the dual listing. I remember, in fact, when I was a salesman, I did, I don't know, maybe $2 billion of this trade for long-term capital, which obviously blew them up. But the point being is I don't know how they trade any longer, but my guess is there's the pairs trades, because you've basically got the UK entity and the Hong Kong entity. If they trade at the same price, they won't trade at the same price in the future, because the Hong Kong entity, because it's bankruptcy remote, will have to trade a massive discount.
Well, that'll be for you to engage in and not me, but
yeah, I need to
it's definitely an interesting idea.
Yeah. So I think, it's super interesting, because a lot of people just haven't looked at this yet. And I think what you're onto is something that nobody's been talking about. I like the fact that most people will be cynical about it as well.
Oh yeah. Well, look, 1 or 2% of the people end up getting it right, and in things like this.
Yeah.
Right.
That's right.
You look back to Switzerland going through the strong side, or you look back to the tequila crisis or the Thai baht, or, there's so many other situations that just caught everyone by surprise. If you just took the time to analyze it, it wouldn't have caught you by surprise. And if you watched what the wealthy were doing in all of those situations, you'd have known what was going to happen.
So the worst question of all, time horizon.
Yeah, I mean, it's 36 years, Raul. I mean, it'd be arrogant to say that you have any idea when that's going to happen.
You can't get away with saying, I have no idea.
Okay. If 80% of the rainy day fund is burned up in a year's time, in time continuums, is 12 to 18 months a long time?
No.
I don't think it's very long.
No, I don't think so at all.
So I think in 18 months from now, you're going to know what happened.
Yeah.
You were going to know. And it's probably sooner. I'm hedging.
Yeah, no, I get that. Yeah, I think it probably is. If it's going to happen, it's likely to happen relatively soon.
Yeah.
Well, Carl, it's brilliant. Thank you for coming back and unveiling the big trade. I think people are going to be super interested by it. And
thanks.
Thank you so much for your time.
So there you have it. The big trade, it's Hong Kong. And that's what interests me about Hong Kong is I lived and breathed the 98 Hong Kong dollar peg crisis and all of the things going on. I know how people are scarred by this. Nobody wants to take on the HKMA, but Kyle does, and I think that's interesting. It's ballsy as well. But I think his thesis is sound, it's interesting, it's unique. You don't hear it a lot. Very many people are dismissive. And I also know people say, well, Kyle said this about Japan, and Kyle said it about China. This is the game that we play. Not everything comes to fruition, but when you've got an opportunity like this, with a really skewed risk reward, you can make exponential amounts of money when you get them right. Sometimes you don't get them right. But the point being is the facts tip probability wildly in the favor of this trade. And I think it's interesting. It's also interesting, I asked Carl, I said, hey Carl, so tell us what trades you're doing. He's like, well, did Coca-Cola give away their secret sauce? I'm like, oh God. People want to know. But he's not going to give us that. But what I do know is, and I asked him in the interview, there's a lot of knock-on effects. And again, he was kind of lips sealed on the knock-on effects. There are knock-on effects. I talked about the Hong Kong dollar pairs trade in HSBC. There's obviously abilities to trade the currency, and there are the effects on the markets around it. I think the Australian dollar, or whether it's the South Korean one, or some of the other currencies will get caught up in this, or whether it's some stock markets. Or you can just distill it down to, if this happens, people are going to buy US government bonds. So buy bonds. Either way, there's lots of ways of skinning this cat. You can filter it into your own investment decisions, but I think it's an important one and a fascinating one. So let's see how it plays out.